The new tax bill just increased bonus depreciation rates back up to 100%. It also makes the increase permanent this time without expiring, and even allows retroactive treatment back to January 19th of 2025. This single provision will allow business owners, independent contractors, and qualifying 1099 earners to greatly reduce their taxes by making strategic purchases that not only cuts their taxes, but also helps them generate even more income and build even more wealth. But right now, there is a lot of confusion around how this actually works, leaving many people unsure about whether or not they can take advantage of this provision in a way that makes sense for them. So in this video, I am going to give you a very simple and easy to understand breakdown of bonus depreciation as a practicing CPA that has helped people benefit from this provision hundreds of times at mycpacoach.com. If that sounds good to you, please hit the like button below, comment your thoughts as we go through this, and let's go ahead and dive in. Okay, so to understand why bonus depreciation is so powerful, you must first understand non-deductible expenses, specifically asset purchases that you spend money on that you are not typically allowed to write off on your taxes. So let's go ahead and break this down. Okay, so when you buy business or investment property, usually that purchase is classified as an asset purchase, not an expense. So when you buy business vehicles, equipment, machinery, furniture, tools, fixtures, or really any type of tangible asset, that purchase is usually classified as an asset purchase. You are exchanging one asset, your money, for another asset like property, which has future value, right? And because of that future value, the tax law does not recognize the money you spend on that asset as an expense, which means you cannot typically deduct that purchase on your tax return, by default anyway. Instead, they allow you to take something called depreciation against it. This is a non-cash tax deduction that allows you to write off the cost of that asset over many years or its useful life, according to the IRS. The IRS has different property classes which are used to calculate your annual depreciation deduction, ranging from 3-year property all the way up to 39-year property. And your deduction would be limited to the purchase price of that asset divided by its useful life in years under the most basic form of depreciation, okay? Which is called straight line. For example, a $75,000 business vehicle with a 5-year useful life would be able to take about $15,000 of depreciation as a deduction on their taxes under this method. Now let's add bonus depreciation to this equation. So with bonus, you will be able to write off up to 100% of qualifying purchases instead of being limited to a partial deduction. So instead of getting a $15,000 deduction in our example, you could get a $75,000 deduction on the same purchase. The only difference is that we are now using the new bonus depreciation rules instead of the standard method. So instead of spreading our depreciation over several years, we're basically taking 100% of it in one given year, which in turn reduces our taxable income and our taxes. For example, a $15,000 deduction may save someone in a 37% tax bracket about $5,500 in taxes, whereas a $75,000 deduction could save them nearly $28,000 in taxes. But your purchase must qualify for this, and you should be aware of the potential repercussions of doing this incorrectly and triggering an IRS audit or having a surprise tax bill later when you go and sell your property. So let's go into this a little further here. If you are seriously considering making strategic purchases that qualify for bonus depreciation, the first major requirement you need to meet is the business use requirement. Under this requirement, the asset you are purchasing must be used more than 50% of the time for qualified business purposes. And a qualified purpose typically involves the intention of using that asset to help you earn more income or profit through your trade or business. And if it does not meet this simple requirement, you cannot use bonus depreciation, plain and simple. At our firm, we help our clients find strong use cases in order for them to meet this requirement with careful planning. So please be sure to do your research here or get a CPA involved if necessary. Now, the next big requirement you must meet in order to use this is that the purchase must be for qualified property. Bonus depreciation strictly applies to tangible personal property, which is property that can be felt or touched and physically relocated. So property connected to land, even the land itself or buildings attached to it, does not qualify for bonus depreciation. But some property inside those buildings may qualify. And intangible property does not qualify for this either, like patents, trademarks, licenses, or any type of property that you cannot physically touch with your actual hands, okay? But the things you can touch and can move does qualify, like cars, equipment, appliances, and so on. But you have to be careful with this because even with those purchases, special IRS rules may apply. For example, with car purchases, bonus depreciation is capped at an annual limit for vehicles that weigh less than 6,000 pounds, but it is not capped for qualifying vehicles over this weight limit. Real estate's another one you have to be careful with because with real estate, all of the fixtures, appliances, and things connected to your investment property are usually lumped together with the entire building and depreciated according to the useful life of the building, which is either 27.5 years or 39 years depending on the property. But with a cost segregation study, you can actually separate those components from the building and use bonus depreciation against certain components inside of it. And these are just examples. It is absolutely critical that you understand the nuance in the tax code around certain purchases if you are looking to benefit from 100% bonus depreciation. Now let's move on to the third major requirement, which is that the property must be new to you. Now, this does not mean that this only applies to brand new property because you can actually use bonus depreciation when you purchase used property as well. But the key here is that that property must be new to you, or in other words, it cannot be previously used by you, your business, or a related party, even like a family member or another entity that you control. And then there's the easiest requirement, but also still very important, which is that the property must be placed in service after January 19th of 2025. Now, placed in service means that the property is ready and available for its intended use in your trade or business. If you purchase a tangible asset, but do not make it available for use, then the property would not be considered in service and you will be unable to claim bonus depreciation against it. Bonus depreciation is applied in the year that that property was placed in service, not when it was purchased. So do not miss out on this if you are looking to claim 100% bonus depreciation. Now, if you meet these 4 requirements, you should be able to claim 100% bonus depreciation. But I would be doing you a disservice if I did not warn you of something that can trigger a surprise tax bill from using this strategy. And it's called depreciation recapture. And as a CPA, I have seen this completely wreck some of my clients who did not plan for this in advance. So please pay close attention here. So depreciation recapture is triggered when you sell or dispose of property that you have depreciated, and it could cause you to recapture some or all of the depreciation you claimed as income on your tax return. This is easiest to understand with an example. So let's go back to our original example where we claimed a $75,000 depreciation deduction against a business vehicle that we paid $75,000 for. So when you claim depreciation, your basis, which is basically your cost for tax purposes, decreases with it. So our basis went from $75,000 down to $0 when we took 100% depreciation. But if we turned around and sold that property for, let's say, $80,000, we would have to recapture every dollar of depreciation we took as ordinary income, plus pay tax on the $5,000 of additional capital gains. Whereas if we took no depreciation at all, we would just have $5,000 in capital gains, not $75,000 of additional income reported on our tax return. Now, this is an exaggerated example that assumes your property increased in value after using it, which is usually unlikely. Property usually loses its value over time, especially things that depreciate quickly like cars. But overall, this is something that you need to be mindful of if you're planning on using bonus depreciation, as it can be a painful surprise for many people who, again, do not plan for this in advance. But with careful planning, you can decide when and how to best dispose or sell your assets to limit your tax liability by as much as possible. And if your CPA is not working with you year round to plan around strategies like this to keep your taxes down, just apply to work with my team today at mycpacoach.com.